Okay, welcome back everybody. We are moving on to the Great Recession, the Great Depression. We're also going to go through federal budgets, which will lead us into fiscal policy, government spending, government taxing, transfer payments, which can be contractionary or expansionary. And then we'll finish up with the latest on the COVID edition of your book and what it did to long-run aggregate supply, short-run aggregate supply, and aggregate demand. So we have the year 2000, and we're going into, it's 2000, 2001, 2002. And, folks are buying homes, but what's happening is banks are writing more and more mortgages, and quite honestly, they're making quite a bundle, writing these mortgages. So they start lowering their criteria to to the folks who want to buy homes. And what's happening is people who really perhaps shouldn't be getting a home of that size, all of a sudden the bank says, "Oh, that's all right. We're going to give you an introductory rate of 6 months or a year, and that'll help you along." And people are thinking, well, if the bank thinks I can afford it, I must be able to afford the home. So people are buying homes. Banks are writing more and more loans with less backup. If you watch the Crash Course video, they talk about a ninja loan where no income, no job, no assets. And what was happening is the home prices of homes just started not going up, but they started to balloon. And as the banks are writing more and more of these mortgages, the balloon was inflating faster and faster. On top of it, we had the folks who were thinking that even knew that they couldn't afford the home, and that's all right, because as long as they had that teaser rate, they weren't going to ever move in. And what their thought was, well, the prices are going up so fast, I'll sign the papers, hold the house for 3 or 4 months, then I'll flip it, and I'll make a killing. And a lot of people thought that, and in the beginning, that's exactly what was happening, which even added to the balloon being inflated even faster and faster. And as we see in economic history, balloons are not a good thing. They always have a tendency to pop, whether it's Dutch tulip bulbs or, in this case, homes. So, in fact, I had a friend. She bought a home in Grosse Pointe. It was a small home too, and she wasn't going to move into it. And she told me she just bought this house on such and such a street, and she said, I paid $200,000 for it. And I thought, at that time, wow, that is a lot of money, because they were nice homes, but they were really, really, small homes, very nice, but small. And I thought, wow, that is an awful lot of money to pay for that home. There's no way. I mean, that house should maybe $120,000. Anyway, she said on top of it, you know what? I'm going to sell that house for probably double in just a year or so. Well, unfortunately for her, she got in at the tail end when they ran out of W&A, folks who are willing and able to buy more homes. So when the supply of folks who were willing to enter into this unbelievably expanding job market dried up, and then the price of housing started to stable, then it started to go down, well, the bubble burst, okay? And all these people were holding mortgages on homes that they were completely overpriced, okay? And what happened that led to, all of a sudden you thought for a while you thought you were wealthy, and then the bubble burst, and guess what? We're no longer wealthy. And so when we see a huge strategic decline in consumer wealth, well, what does that lead us to? Well, it leads to demand actually going down, and on top of it, you have not just wealth, but you have expectations really going down, and that will certainly lead to a contraction of the economy. Remember, Milton Friedman said expectations are hugely important, and they really are. It's almost like like a self-fulfilling prophecy. Everybody feels, if you and I feel that things are pretty good and they're even going to get better, generally, if that is the mood, things will tend to get better. However, if we all think that things are, they're not really all that great, and they're probably going to get worse. If your friends and family are like that, well, you're not going to buy that big screen TV. You're not going to, that second car you're thinking of buying, you're probably not going to buy it. Anyway, that all leads to exactly what happened here. Aggregate demand shift to the left. All right. Now, in this case, this great drop also led to a great drop in the health of the entire financial institution, of the entire financial market. All the financial institutions were shaken. All right. Government came in and with the TARP program, and if any of you ever have a chance to watch Too Big to Fail, it's a great movie on the Great Recession and what happened. And what happened was the government came in, they pumped a lot of money to try to stabilize the financial institution, because remember when we talked about long run aggregate supply. For that to move, some fundamental in the economy has had to change. Again, it's not a little hurricane hitting Miami and doing some damage. It would be some unbelievable storm ripping the entire East Coast. That would change the long-run aggregate supply. And that's what happened here. So we had long-run aggregate supply shifting to the left along with aggregate demand. So we had what looks like this. Okay, and the government came in trying to stabilize it, pumping a lot of money into the financial system, and the problem was the banks didn't loan the money out. Okay, and that's why the Great Recession lingered, and it seemed to take so much longer to get out of this Great Recession. No matter what it says in most economic books, it was a very long, painful recovery, probably one of the longest and most painfully slow recoveries in U.S. economic history. And we looked at the business cycle last time, and we were talking about, the 4 cycles and the trough and then the recovery. This recovery wasn't like this. It was like barely moving up. All right, so it was a slow process. Painful, absolutely. Unemployment hitting around 10%. Drop in gross domestic product, 9%. So by modern day standards, it was a real toughie. But it was nothing compared to the Great Depression. Okay, the Great Depression. What happened there? Well, it wasn't necessarily caused by the fall in the stock market. That's what usually gets all the publicity. But let's take a step back and say, well, what happened before that? What caused that to happen? So when we go back, we look at, well, what was going on? Well, in the 1920s, we had the Roaring Twenties. 1920, 1928. Things were booming. I mean, we look at new apps on our phone that we really enjoy, or new inventions or technology that we have today. That's great, but I mean, there's a whole lot of difference between having a few more apps on your smartphone, going from having no phone at all to having an actual phone in your house. And that's what was happening in the 20s. We had, people actually getting television. I know it's hard to imagine no phone in your house at all. people getting a phone, all right? And these new companies, RCA, coming up with a record player and phonographs and electric irons and all sorts of washing machines, improved washing machines. So there were not only new products, but they were products that were vastly improved. Even Henry Ford, he started the production line right in 1914-ish. So you can say, well, that had been around for a while. But even when it hit the 1920s, they were putting out some really nice automobiles. So we had the Roaring Twenties. And what the Federal Reserve, which we're going to talk about in the coming classes, the central bank of the United States, it had good intentions. It wanted to support, all this growth. And what it did, it increased or allowed the money supply to increase by $27 billion. Now, $27 billion sounds like a lot even today. Imagine what $27 billion was back in the 1920s. It was a staggering amount. As a matter of fact, it comes out to about 367, that would be $367 billion today, okay? That's a huge increase. So the intentions were good. However, you cannot pump that much money into an economy without bubbles occurring. And boy, did they ever. We had bubbles in stocks. We had bubbles in Florida land, California land, capital equipment market. There were bubbles all over. It was ready to, they were ready to pop. And unfortunately, in 1929 they did. And they seemed to pop all at once. Now, the New York Stock Exchange got the biggest press from it, okay? But it wasn't the cause of it. We have to go back to, what caused it. So, anyway, the New York Stock Exchange got the biggest play. But interestingly enough, from the day it crashed, before government got a chance to get their hands and try to correct the situation, it had recovered 50% of all its loss in 6 months, all by itself. Now, the problem is, it's 1929, and we have President Hoover, and he was an activist president. He gets kind of a bad rap in history that, he didn't care about folks. He was sitting in his ivory tower. He didn't care about, all the people, and they were setting up Hoovervilles and all that. No, it was just the opposite. He was an activist president. He wanted to do something. The problem was they didn't have this class. They didn't have macroeconomics. They didn't have the tools that would that would affect and try to fix an entire economy, all right? So what did he do? He said, well, okay, he's going to take action right away, and he did. So what happened? In all these things, and again, remember, it's easy for me back here in 2022 to say, oh, we should have done this and that and the other thing. Hindsight's always right. But, unfortunately, these actions did cause what should have been a very severe recession to go into the Great Depression. Number one, money supply. They completely reversed course, and they cut the money supply by 30%. Credit dried up, all right? Interest rates naturally went up. I mean, you've got less of something, its price goes up, and that's exactly what happened. And people held on to the little money that they had. They weren't purchasing because we were experiencing, among other things, they were experiencing not inflation, but deflation. And the money was appreciating. So with that, people were even holding on to their few dollars even longer. All right? 2, Hoover came and he said, well, he didn't want the wage rate across the country to drop. So he thought he could get, and he did, he called in all the heads of all the major industries, and he said to them, look, I don't want to hear about any one of you lowering your wage rate in your industry. That better not happen. So all the heads, they were fairly intimidated at first. This happened, and they promised, yeah, okay, we won't lower their wage. And so they went back to their hometowns across the nation. But what did they do? They ended up laying off, a third or a half of their employees. So the results were another disaster. Okay, now third, we passed, and we're going to talk about this in fiscal policy, the Revenue Act of 1932, which had different points to it, but in general, let's say, it generally raised taxes by almost double. Now look, here's a spoiler alert, as you would say. When you increase taxes, that is contractionary. Okay, decreasing taxes will expand an economy, but you don't increase. Now, thoughts were, well, I guess bringing in the federal government's going to need some extra money to help the economy, but when you did that, that really, really, really hurt. Then the final nail in the coffin was this Smoot-Hawley tariff. Okay, it was the most encompassing tariff in the history of the United States. And remember, a tariff is a tax on imports. The rationale was, well, okay, our businesses are suffering. We need to, keep all the business here in the United States. We don't want to let any foreign goods come in that would detract from business for our own domestic operations. And, the thought is good, but the effects were disastrous. What happened was this tariff, it put a tax on everything. Oddly enough, only two things were exempt: leeches and skeletons for medical schools. I mean, not exactly two big loopholes. Anyway, everything else was taxed. Now, what happened was, right after that happened, now you have to remember, even though the year is, we're in the late 20s, early 30s, Europe was still recovering from World War I. A lot of their land still had landmines in it. In fact, I think I saw a program about a year ago. They were still digging up, landmines from World War I. So we were supplying a tremendous amount of grain, to Europe. So the American farmers, that was a big portion of their market, 35%. And what happened? We passed this tariff, and almost immediately we got hit. Something like 27 countries hit us with retaliatory tariffs. All of a sudden, you're an American farmer, you've lost a third of your market. It really just killed the farmers. So this, and among the others, actually drove us into the Great Depression. Okay? Well, let me get the next. All right. So, oddly enough, they said, well, we had it with Hoover. So when 1932 rolled around, they elected FDR, Franklin Delano Roosevelt. And he came in with his 100 days, his first 100 days. And actually, that's where we got that term, the first 100 days is so important. It was from FDR, because he said, he wanted to do, so much in his first, and he did. I mean, he passed 15 major bills, 76 laws, and Congress was pretty much ready to give him whatever he wanted, okay? The problem was all these laws and all these acts, they were too small or too regional. You know, it would help a little area of the country here or there. The only real macroeconomic provision that they passed was the FDIC. That was the Federal Deposit Insurance Corporation. That really did help because that prevented what we used to call bank runs. If any of you ever saw the movie really popular around Christmas time, you know, It's a Wonderful Life, they have unfortunately a great example of what a bank run was. And that a bank run is exactly what it says it is. People literally ran to the bank to get their money. And as we know, any bank that's not holding the money in their vaults, there's not a bank in the country that if all their depositors came at the same time to get their funds could satisfy everyone. They can't, because what does the bank do? A bank is a business that is in business to loan money. All right, so the FDIC, you know, guaranteed your deposits were safe in banks, which, you know, made a whole lot of folks feel a lot better. I mean, imagine, it's hard for us actually to imagine, you know, our funds aren't safe in the bank because we've enjoyed this protection for so long. All right, so anyway, all these programs, at first blush you'd think, well, Craig, in his first 100 days, he got all these bills and acts through. It didn't help. I mean, again, it helped a little bit here and there, but was it enough to lift the entire economy out of the Great Recession? No. It wasn't massive enough, okay? So what do we have? Well, okay, so we had, after Hoover got, all those programs going, I mean, things really, really got bad. So stock market, it did go down in those years, 29 to 32, by 90%. And eventually wages also, they went down big time, 42%. Unemployment, 25%, okay, and probably even higher than that. Economic growth, down 55%. I mean, that's almost staggering to think that it was that big. And this is another important one, deflation at about 20%, some years a little higher, some might have been a little lower, but the key here is deflation. Your money is becoming more valuable. Prices are going down. And again, at first blush, that doesn't sound too bad, having prices going down. But when they go down by 20% and you are trying to work your way out of the Great Depression, it's a killer because people aren't going to spend, or they will wait till the absolute last minute to spend. All right? So that's going to drive aggregate demand even further to the left. And that's exactly what happened. Okay, so should the government act? Well, two schools of thought on this. Keynesian and the classical, okay? Classical economists said, no, leave the economy alone. In the long run, it will self-correct and we will get back to equilibrium, okay? And they cited, as a matter of fact, there was a depression, a real quickie in the 1920s. We had it was short but severe in 1920 that people seem to overlook. And at that time, President Harding, he didn't do anything. Now, interestingly enough, Hoover was the Secretary of Commerce then, and he wanted to do something. He was just chomping at the bit to do something. But Harding said, leave it alone. And they did leave it alone. And you know what? It did self-correct, okay? And it came right back. So here the classical economists are saying, leave it alone. In the long run, the economy, it will be self-correcting. We'll get back to equilibrium. Everything will be fine. I think this case might have been a little more severe, though. And we have John Maynard Keynes saying, no, absolutely, government is needed right now and in a huge way. All right? He was extremely big on government spending, fiscal policy. Now, he thought monetary policy is fine, that's good too, but his key point was increasing government fiscal policy, government spending to shift aggregate demand back, from, the extreme position that it had gone to, all right? And what his answer to the classicals was that famous line was, maybe you are right, maybe you are right, maybe it will self-correct. But remember, we live in the short run, okay? Because after all, in the long run, we're all dead. And it's like you're going home and your kids want to know what's for dinner tonight. And if times are tough, and you tell them, well, don't worry, things are going to get better. They say eventually the economy will self-correct and we'll get back to equal. They don't want to hear that. They want to know what is for dinner tonight, okay? So similarly, we live in the short run, okay? And we might not be able to wait for that long run, okay? So the answer, might have been, well, maybe a little combination of both, okay? All right. Anyway, quickly, when we're looking at the Great Recession, Great Depression, the Great Recession, it did last a lot longer than most recessions. And I think the pain and the lingering factor had to do with the banks, after they got all this money, they didn't loan it out. I mean, if any of you it's probably your parents tried to get, loans around 2012 or so, they were not easy to get. Loans were difficult to get, okay? So that caused it to linger in the Great Recession, okay? But still, it was nothing like the Great Depression. We didn't get out of the Great Depression till 1942, 1943. It was World War II that actually got us out of the Great Depression. That involved such a massive government program that, yes, that did lift us out of the Great Depression. But, as I put down here, I mean, having 60 million people die to get us out of the Great Depression, that's one heck of a remedy. But again, just to take it in context, so you think about it, when we're comparing the two, and it's in your textbook, they talk about Starbucks. Well, in the Great Recession, Starbucks had cut back on their growth, so they were still opening a few stores, not definitely not as many, but they still were opening a few stores. Okay, so that was the consequence. Now, if Starbucks had existed in the Great Depression, they wouldn't have been, cutting back on the number of stores they're opening. They would have been bankrupt. So that's the difference and the severity, of the Great Depression next to the Great Recession. Great Recession, things are really tough, so on and so forth. And in the Great Depression, they were god awful. All right? Okay. In the Great Recession, we just made a lot of bankers a lot wealthier. When they were bonusing each other money. Even the head of AIG, the insurance company that insured the bank when they were taking on all these toxic loans and toxic assets, and they were taking out insurance policies on them from the largest insurer, AIG. All right? Well, AIG took on all these policies, and these were policies on toxic assets. So AIG was in trouble too, and the government had to bail out AIG. Head of AIG, what happened to him? Well, he got a $1 million bonus, and he stepped down as the head of AIG, but they brought him back as a consultant. Matt Damon does a great job interviewing the spokesman for the banking industry in this. So it's a great documentary. All right, so that takes us out of the Great Depression, and hopefully you're not depressed. We can move on to somewhat more enjoyable topics such as government budgets Although sometimes some students say, "Oh, that's a little depressing," but no, it's not. It's all good. All right. So the federal budget. All right. Well, what is the federal budget? Well, basically, you and I, we have budgets, and what money's coming in, what's going out, and we have to weigh where we're going to do our spending. Government is a little more fortunate. They have free access to borrow money. I mean, they will be first in line to borrow if they need to. Or if worse comes to worse, they can always print it. That's something that you and I don't have the luxury of doing, okay? But anyway, other than that, federal budget is similar to us. It's like what's coming in and what's going out. Most of what's coming in comes in the form of taxes, all right? And what's going out typically involves government spending, and that would be on goods and services, and transfer payments, all right? And again, transfer payment, when we talk about transfer payment, most people always think of a transfer payment in terms of government, but it doesn't have to be. A transfer payment basically is a gift. Think of it as a gift. It's you giving someone something, and you're not asking for any good or service in return. That's a transfer payment, okay? If you're sending money, as we did to your relative years and years and years ago, to some relatives over in Europe, every couple of months, send them some money. That's a transfer payment. All right, we're transferring money to someone else. We're not getting any goods or services in return. That is the generic term of a transfer payment. Now, in terms of government, which most people think of it that way, it is unlike government spending on a good or service, it is a transfer. It's transferring wealth or money from one sector of the economy to another. Okay, we look at most books have Social Security as the greatest example of a transfer payment. Now, if I were you, I wouldn't talk about Social Security as a transfer payment around anybody who's 66 or 67 or older, because you're going to get a huge argument. They're going to say, hey, wait a minute, we paid into that fund for 40 years, and that's no transfer, that's no gift. That is us getting our money back. So you don't want to get involved in that argument. So when you think of a transfer payment, you could think of something like unemployment compensation, okay? Folks are getting some money, from the government, and they're, we're literally not giving any good or service in return, okay? That would be a transfer payment, okay? Now, again, pretty basic. If the government income, what comes in, is greater than what's going out, we have the rare, although it does happen, budget surplus. If government income, their spending, if government income, what they get is less than what they're spending, the outlays, then we have a budget deficit, okay? So, income greater than outlays, surplus; income less than outlays, a deficit. Now, if we add all the government deficits together, all right, and the occasional surplus, okay, if we add it all together, we end up with what is called the national debt, okay? Now, the national debt, we have to remember, you look at that debt clock, and I remember it was 18 trillion, and it was in the low 20s and the mid 20s and the high 20s, and hitting $30 trillion. I mean, no doubt about it, that's a lot of money. But the key ratio, the key statistic that we really have to look at is, yes, national debt is important, but the key statistic is the ratio between debt to our GDP. In other words, how much do we owe next to how much stuff, our new goods and services are we actually making? That is the important statistic, okay? Now, for many years it was averaging about, 98%, 100, meaning 1 to 1 or maybe 105. Now, COVID kind of threw us all off, threw the whole ratio off, and not unexpectedly. We had to engage in some massive government spending programs. I mean, whether it was the Trump administration or the Biden administration, both, had to engage in massive spending. So, it stands to reason that this ratio was going to change. But even with all that spending, our ratio, was 137%, which, doesn't sound great, because back in 1981, it was all the way down to 32%. But with COVID, I mean, at 137%, you're thinking, well, with all that spending the government did, it's really not quite as bad as, at least a lot of folks had imagined it. And this doesn't mean a disaster, because Japan's ratio has always been much, much higher than ours. In fact, in 2021, Japan, they were at 228%, okay? So their debt was more than double what their GDP was, okay? And I don't think any of us would consider Japan a basket case economically. I mean, we always tend to think of Japan as having a strong economy. So, we have to keep these things in context, all right? So, when we got the budget, now let's look at these federal outlays. So, the federal outlays break down into 3 general categories: mandatory, discretionary, and interest on the debt, okay? Mandatory, that makes up, actually, that's quite a big chunk of the outlays. 62% of the outlays are mandatory. That means we can't change it. The government cannot change, mandatory spending unless they change the law, okay? The biggest of these are fixed costs would be Social Security and Medicare, okay? Those are the 2 big chunks, all right? Medicaid is also a pretty large segment, but Medicare and Social Security are the biggest. These cannot be changed. They're mandatory. All right, the second is discretionary. Can be changed, okay? The government can, bring it up or down depending on what they want to do. That's about 30% is discretionary. National defense falls under discretionary. Some folks would argue, well, national defense shouldn't be discretionary. At least, half of it should be mandatory. And, there's arguments that have been made about that. Anyway, at least at this point, we're labeling defense spending as discretionary. It can be changed, okay? Other things would be, spending on infrastructure, on docks, on loading facilities, interstate highways, also number of federal government employees. How many great government economists are we going to have? And after going to school in Washington, D.C. for 4 years, I met an awful lot of government employees, but we won't go into that. Third is interest, and that's around 8%. All right? Now, fortunately, over the last few years, and I'm sure the government realized this, the interest rates have been extremely low. So, you're thinking, wow, we've got this huge national debt, and it's 8% of outlays. Just think what percent that would be if the interest rates were, I won't say normal, but what, folks were, used to back in the late 60s, mid, 70s, late 70s. With the interest rates, if the interest rates were anywhere near those rates, this would be a staggering figure. It wouldn't be 8%. Fortunately, interest rates are very low, so it's not as bad as it seems. Is that mandatory, discretionary? Well, some folks actually argue, well, it's discretionary. We could default. Well, we could, but that would send such a shock wave through the financial system of the entire world that I think we better keep the interest rate with the thought of that's more of a mandatory payment. We couldn't afford to have, yeah, we could, say, hey, we're not going to pay it. It's not the, but the consequences would be too severe. So let's say that, okay, yeah, if absolutely, some folks will argue you could default, but realistically, we pretty much have to pay it. Okay. Oh, and by the way, if you have the second edition, I pointed this out years ago. China doesn't hold $1.2 billion of our debt. It holds it doesn't hold $1.3 billion of our debt. It holds $1.3 trillion of our debt. Big difference, okay? All right, so that is on outlays. And now we'll talk about income. Okay, so now we're on the other side of the coin. Government bringing money in. Okay. Well, taxes obviously would be the 99.9% of the amount of funds coming in are through taxes. All right. Interestingly enough, the biggest is personal income tax. Almost half of government income comes from you and I, personal income tax, okay? It started in 1913. Before that, boy, that, I'm always startled when I think of that. Before 1913, we didn't have personal income tax, all right? Interestingly enough, 1913 was also the year that the Federal Reserve came into being. Anyway, before that, how the government got their money was a tax on goods, tax on whiskey, tax on imports, tariffs, duties, customs duties, and that sort of thing. So that's where the government got its money. All right. Anyway, in the early years, it was actually a status symbol for you to say, hey, you know what? I pay income tax. So when it was first passed back in 1913, 1914, if you told somebody, I had to pay 2%, income tax, that was a big deal. You were really, bragging about it. Times have changed quite a bit. I don't think any of us consider income tax as a status symbol. But anyway, we'll move on to the other one is payroll taxes. Very important. Payroll taxes almost 36%. And that consists of taking care of Social Security and Medicare. All right? And that's the one that, you pay and your employer shares and pays the same rate. We both end up paying about 7.65%. And that covers your Social Security and your Medicare, okay? But, and this is one that, if you go out and get a summer job and you say, don't take any deductions out for me, You know, when they're asking you how many dependents or so on and so forth, you say, no, I'd rather not, you know, have zero. I'll go with zero. I don't want any, you know, they're still going to take the payroll tax out. There's no way you're getting away with that. You absolutely are going to have the payroll tax taken, okay? And the IRS is very unforgiving when it comes to payroll taxes. I mean, if you ever have a business and you're running, you know, you have, not that you're going bankrupt, but you're just having a cash flow problem, the IRS will work with you if you owe them, you know, corporate taxes. But don't ever, ever, and believe me, I am advocating everyone pays their taxes, but payroll taxes is one that they will actually shut your operation. I mean, you don't absolutely ever want to neglect your payroll tax. You can work with the IRS in terms of some back taxes that your business has, but you don't ever fool around with the payroll tax. All right, third is corporate tax, which is only 7.8%. Actually, that always kind of surprised me. I thought it was going to be when I was a student. Before I knew, I thought it was going to be a lot higher than 7.8%. Anyway, 7.8% is that corporate tax, miscellaneous tax. That's all the other taxes: excise tax, gift tax, estate tax, and that comes to about 6.6%. I listed one more because it is a very, very, very small source of income. Probably couldn't even put a percent on it, but it is gifts. If you went, for instance, to a national park, and you went to Mount Rushmore, let's say, for the summer, and at the gift shop there you bought a couple of souvenirs. Well, that would be income for the federal government. So again, it's so small, it's almost can't even really put a percentage figure up, but it is a small amount of money. But just so you'll know, it's up there. Okay, what I'd like you to think about, I'm going to close this video because I don't want to get too long. We're going to open up the second video for this week. What is better? You know, is a progressive tax better than a flat tax? I mean, is it, you know, flat tax, everybody pays the same, and there's no, you know, no deductions, everybody has the same amount? Or is progressive better, saying, yeah, you know, if you're getting richer and richer, you know, you should pay a bigger and bigger chunk of your money, you know, for the fact that you are, you know, moving up in terms of wealth and moving up into higher levels of income. So it's interesting. That's a debate that is going on and on. It won't be settled in this class, but it's just interesting. I know that a lot of very educated CPAs have a fear of, you know, if we ever passed a flat tax with no deductions, because that would curtail quite a big chunk of their business. So anyway, all right. So this is our first tape. Then we're gonna get into fiscal policy and how it can be contractionary or expansionary. All right. Okay, everybody.